take up the next important concept for discussion, that is dealing with semi-annual coupon payments. Now, most of the bonds you will find that they are offering half yearly payments or semi-annual payments. So what will happen if the bond's coupon rate is 6%, but it is paying semi-annually? It will pay 3% for each half year, means twice in the year you will be receiving the payment, and twice in the year each payment will be half of the annual coupon rate. Half of the annual coupon rate. So 6% is the annual coupon rate, but the bond is offering semi-annual payments. So every half year the bond will make a coupon payment of 3%. So how do we go for valuation of a semi-annual coupon paying bonds? Very simple. You identify that the bond's life or the remaining tenor of the bond, suppose it is 2 years, then the bond is going to pay 4 times the semi-annual payments, 4 times. So 2 years divided into half year period or semi-annual period, there will be 4 periods. And if the annual coupon rate is 6%, the bond will actually offer you 3% for every period of 6 months. So what happens? The number of periods gets doubled up and the coupon rate becomes half. Now what about the discounting rate? Your discounting rate is also a per annum rate. Even that you need to adjust for semi-annual payments. That is by making the calculation based on half yearly or semi-annual payments. So what you will simply do is, you will simply take the discounting rate divided by 2, because annual discounting rate, when you divide it by 2, you will be getting the discounting rate applicable for the required period of half year. So let me do one thing, let me first give you some notes on this, and then when we take calculative examples, things will be much clearer. So time for you to write these important notes first. So in these notes, under the heading semi-annual coupon payments, you please write, when a bond pays semi-annual coupon payments, the valuation process is slightly adjusted to account for more frequent payment periods. Coupon payments, since payments are made semi-annually, the annual coupon rate is divided by 2. Required rate of return, that is RRR, the annual RRR is also divided by 2 to reflect the semi-annual periods, and number of periods, the total number of years to maturity is multiplied by 2 to reflect the number of semi-annual periods. So both coupon rate and required rate of return will be divided by 2, and the number of periods will be number of years multiplied by 2. This particular adjustment you need to carry out for making the valuation of semi-annual coupon paying bonds. Alright friends, once you have completed writing these notes, let us move ahead and take up a calculative example. It says, consider the following information about a semi-annual coupon bond. Face value $1,000, annual coupon rate 7%, maturity 2 years, required rate of return by investor is 6% per annum. Determine the present value of the bond. So the usual approach of making the calculation with a little bit adjustment required. What adjustments you are going to make? No changes in the face value, keep it as it is. Annual coupon rate will be divided by 2. So instead of 7%, the coupon rate will now be 3.5%. Maturity period is 2 years. So number of periods will not be 2, number of periods will be 2 into 2, that is 4. Required rate of return is 6% per annum. Again divide this rate by 2 to arrive at the semi-annual rate of 3%. So just use your calculator and do the needful calculation, and let us see what calculation you get and whether you get the correct answer or not. I give you, alright friends, I have given you enough time to answer this question, and I am sure you would be ready with the correct answer. So the correct answer will be arrived at by making these adjustments. Semi-annual coupon payment will be $1,000 into 7% divided by 2, that will be $35. Semi-annual required rate of return will be half of 6%, that will be 3%, and semi-annual periods will be 2 years into 2, that is 4 periods. Considering all this, the value of the bond will be computed in this way. So $35 will be semi-annual coupon payment and 3% will be your discounting rate. Considering 4 periods, the present value comes to $1,018.59. So if you would have obtained exactly this calculation, that means you are correct, else you need to check your calculation and rectify the same. Alright friends, so once you have completed writing all this, let us move ahead and observe the steps on your calculator. So same usual steps, but keeping in mind all this revision. Press second and FV for clearing TVM, second and then FV. This you should do without failure all the time. Input 4 and then press N. Keep in mind one thing, this bond has maturity coming in 2 years time, but we are still keeping the input for N as 4 years. Then input 3 and then press I by Y. This is the input for your discounting rate as 3% for every 6 months. Input 35 and then press PMT. This is the input for your semi-annual coupon payment. And input 1000 and then press FV. This is for the par value receivable on maturity. Then what you need to do, press CPT and then press PV. CPT and then PV for computing the present value, and the result what you obtain, PV equals to negative 1018.59. Alright friends, once you have completed this whole thing, let me take you ahead and explain something important over here. In fact, very important. Yield to maturity, YTM. Now, very important for you to understand, because throughout bond valuation, not just at your current level, even at level 2, you will be having frequent use of YTM. What is YTM? You being a bond investor, you have invested your money, and based on your investment made now, you are going to receive some cash flows in the future. These cash flows will indicate the interest earned by you and the principal repayment after a certain period. So that is coupon payment and maturity value that you are going to receive in future. These are future cash flows. You need to connect this to the market price prevailing now, because that is the money that you will invest today to buy this bond. The discounting rate that will match up these future cash flows with this market price of the bond is the internal rate of return for the bond investor. This internal rate of return for the bond investor is what we identify as yield to maturity. That means what yield the bondholder will earn if the bondholder is buying the bond now at the current market price and holding the bond up to maturity. Then the bondholder will be earning this yield. This yield is always stated on the basis of per annum. So when you are computing YTM, you have to just understand one thing, that it is nothing but the IRR of the bond. Now, when we have learnt computation of IRR under the topic time value of money in quants, do you recollect one thing? We have learned two different types of scenarios. One is when you have a constant cash flows ahead and you want to compute IRR. It is a simplified calculation. But if the cash flow every year is varying, then computing the IRR becomes little tedious work, because then you have to go with the cash flow approach inbuilt in your calculator. So we have learnt every tiny bit of calculation procedure under time value of money within quants. Now this is just the application of that. In fact, if you remember, when we were learning the application of TVM in finance, that particular topic within your quants, we have already introduced some calculative examples of bonds over there. So computing YTM is basically determining IRR of the bond. So you should be very clear with one thing, that YTM is such a discounting rate which will connect the future cash flows of the bond to a present value which is in parity with the quoted market price of the bond. So current market price of the bond, when related to the future cash flows, the connecting discounting rate is the YTM. That is the true rate of return the bondholder will earn. Now when it comes to yield and yield measures, we have made some discussion about this in the past, and elaborate discussion is yet to come ahead. A bond investor will always be concerned with what yield he or she is earning. Correct? That yield could be current yield, that yield could be yield to call, it could be yield to maturity, depending upon which yield you are trying to determine. For example, someone can tell me that, sir, buy this particular bond, it is giving you 9.6% as YTM. Then I ask that person, how much is the remaining maturity period of that bond? That person says, the remaining maturity period of this bond is 11 years. Boss, I don't want to invest for 11 years. I want to park my money in bond market just for say 1 year. So I am concerned with what yield I will be getting in 1 year time. Then my concern is the current yield. What will I do with the computed YTM if I don't want to hold the bond till maturity? Makes sense, right? In that case, the bondholder or the investor is concerned with the current yield of the bond, and current yield is going to just give you, without any uncertainty, you are going to receive the coupon payment, and whatever be the market price of the bond by end of the year, you will sell the bond at that price. The par value as a redemption by the bond issuer will not be obtained by you, because the bond has not become due for its redemption or matured. Therefore its par value you won't receive. The only way to get back your money is to sell the bond in the secondary market. So what is to be done over here? You need to understand what is yield to maturity and how to determine the yield to maturity under different circumstances, including the situations where you have to find yield to maturity for a semi-annual coupon paying bond. So let us do one thing. Let us first write some important notes over here. Under the heading yield to maturity or YTM, you would write, this is the rate of return which is generated by a bond over a period up to its maturity. If the future cash flows of interest and redemption price are discounted using YTM, the present value of such cash flows will be equal to its actual market price. The price of a bond and its future cash flows can be used to calculate an internal rate of return, that is IRR, known as the yield to maturity or YTM, which serves as a useful return measure for fixed income. Alright friends, once you have written these notes, let us move ahead and take up another example. Example 5. Consider the following information about a bond. Face value given as $1,000, annual coupon rate 6%, maturity 5 years, current price of the bond is $920.15. Determine the yield to maturity of the bond. So how will you determine the YTM of this bond? You know, you need to arrive at a discounting rate which will match these future cash flows of coupon plus the par value should match with the present value, which is $920.15. So you set an equation where you are considering I as the discounting rate. So it is 1 plus I raised to 1, 1 plus I raised to 2, 1 plus I raised to 3, which are becoming the values in the denominator for each of these future cash flows, and each term over here indicates the present value of each individual cash flows. Now when you compute this overall present value, it must match with 920.15. So what should be the value of I through this equation? So the value of I, which represents YTM, will be exactly 8%. And how to put it through your financial calculator, I am going to guide you. Alright friends, once you have computed this whole thing and you have written this, maybe some of you would not know how to compute this 8%. Let me guide you directly through the calculator. So turn on your calculator, and the first thing that you need to do as steps for yield to maturity or YTM, after turning on your calculator, first press second and then FV for clearing TVM calculations of past, then input 5 and then press N. Now we cannot give input of I by Y because we don't know the discounting rate. Discounting rate is what we need to find out. So this time I by Y is missing. We are going to compute I by Y. So input negative 920.15 and then press PV. You know the present value, when you are putting in, you must put in the present value with a negative sign, and that is to be done because this present value will be indicating a cash outflow from your pocket. Then automatically the bonds future payments in the form of coupon payments and par value will be positive values. So the payments, that is PMT and FV, both will be the positive values. In that case PV has to be the negative value. Keep this caution. By mistake, don't just input 920.15 as PV. You must input negative 920.15 and then press PV. Thereafter, other things, input 60 and then press PMT for annual coupon payment. Then input 1000 and then press FV. Thereafter, press CPT and then press I by Y, because here discounting rate you want to compute. So press CPT and then press I by Y. You will be getting the result as I by Y equals to 8%. That is your YTM. Alright friends, once you have completed writing all these steps, let us move ahead and now write this heading, YTM versus coupon rate. Now let me have this important discussion about YTM versus coupon rate. Why are we comparing YTM with coupon rate? If you again take some basic examples, suppose a bond is offering 6% coupon rate. The maturity of the bond is after 5 years, and the required rate of return by the investor is, say, 7%. Immediately identify what is going to happen. You will get to know whether the investor is expecting at par with what coupon rate is offered by the bond. Is the investor expecting more than that? Is the investor expecting less than that? So the moment you find that investor's expected rate of return is little different from coupon rate, it will impact the value of the bond. Now, right now the focus point for us is not the required rate of return by the investor against the coupon rate. We are in fact comparing the YTM with the coupon rate. So what would happen? What would happen when YTM and coupon rate are exactly the same? So imagine that a bond's coupon rate is 6% and its yield is also exactly 6%. That means the bond's par value being $1,000, to buy that bond today, the price also is exactly $1,000. That means the bond in that case is traded at par. Traded at par means you can buy that bond by just paying the par value. That is what we mean by traded at par. Inversely, if the YTM of the bond is greater, means the bond's yield is 7%, where bond's coupon rate is 6%. That means bond is showing that it will pay 6% coupon rate, but its real yield is 7%. How is this going to work? This is possible when the bond is traded in the market at lower than its par value, correct? So if you buy the bond at its par value, then you will earn 6% yield. What if you buy the bond at a lower price and you are going to earn 6% coupon, and after some number of years you will receive the par value? So you are investing something less than 1,000, then your rate of return will be obviously greater than 6%. That means the yield of the bond is greater than 6%, and that means YTM is greater than the coupon rate. So when YTM is greater than coupon rate, what is the signal that you get? When YTM is greater than the coupon rate, what signal do you get? That bond's yield is greater than the coupon rate that it is promising. And what would happen in that case? The bond is traded at a price lower than its par value. I repeat, bond is traded at a price lower than its par value. Imagine what would happen when the bond is traded at a price higher than its par value. So par value is $1,000, but I say you have to invest $1,036 to buy this bond today. So bond is going to give you 6% coupon rate. On maturity, you will be getting the par value, that is $1,000. So you are investing 1,036 today. You will be getting only 6% coupon rate, that too not on the money that you invested. You will compute the 6% coupon rate on the par value only, right? Because coupon rate is applicable on the par value, irrespective of what price you paid to buy the bond. So what would happen? In that case, you are receiving lesser cash flows and you have invested more money. Then you will understand that, okay, bond is showing 6% coupon rate, but its yield is not 6%, its yield is lower. Its yield is lower because you are buying the bond costlier. Let us conclude the whole discussion. When YTM is same as coupon rate, the bond is traded at par, means the bond par value and its market price both are same. This will happen when YTM is equal to coupon rate. When YTM is greater than the coupon rate, bond is traded at discount, and when YTM is less than the coupon rate, bond is traded at a premium. When I say premium, means greater than its par value. When I say discount, it is lower as compared to the par value. So let us write up these important notes over here without delay. Under the heading YTM versus coupon rate, please write, if YTM greater than coupon rate, the bond is selling at a discount, that is below the par value. If YTM less than the coupon rate, the bond is selling at a premium, that is above the par value. If YTM is equal to coupon rate, the bond is selling at par value. Alright friends, once you have completed writing these lines, let us move ahead and write further. Intrinsic value of a bond. Now this is something that I have explained to you little earlier. Intrinsic value of a bond represents its fair value. When the bond's present value is computed not using the YTM as discounting rate, but using the expected rate of return by the investor or required rate of return by the investor as the discounting rate, the present value that you arrive at will be the intrinsic value of the bond. Technically, it is called intrinsic value. In real sense, it is basically the fair value of the bond. when you go for fair valuation of any asset for a fixed income security like bond, we call that value as intrinsic value. So keep in mind one thing, when YTM is used as discounting rate, the present value will indicate the current market price, but when required rate of return by investor is used as a discounting rate, the present value will indicate the intrinsic value of the bond. It is intrinsic value of the bond which is the main computed value. Why I am calling this as main computed value? Because whether you should buy the bond or not, you ultimately will compare nothing with the par value, but you will compare between these two values, the intrinsic value and the market price. Because if the market price is greater than intrinsic value, we would say that the bond is overpriced. If the market price is less than the intrinsic value, we would say that the bond is underpriced. So intrinsic value is the benchmark. That is, I would say I am willing to pay that value. If the market price is more than that, the bond is overpriced. If it is less than that, it is underpriced. Any overpriced bond, I am not going to buy. In fact, if I have that bond, I will prefer selling it. Any underpriced bond, I will definitely try to buy. If the bond is traded at its proper value, then it is advisable to simply hold the bond. So whether to hold the bond, buy the bond or sell the bond, what action you should take in the bond market, that is observed by comparing these two parameters, that is the intrinsic value of the bond and the current market price of the bond. So let us write some notes about this. The intrinsic value of a bond, often referred to as its fair value, is the present value of all future cash flows expected from the bond discounted at an appropriate rate. The cash flows include the periodic coupon payments and the face value repaid at maturity. The intrinsic value helps investor to determine whether a bond is overvalued, undervalued or fairly priced relative to its market price. If the market price of the bond is lower than the intrinsic value, the bond is undervalued, indicating a potential buying opportunity. If the market price of the bond is higher than the intrinsic value, the bond is overvalued, indicating a potential selling opportunity. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. YTM versus required rate of return. I have explained this to you already. Just start writing these notes. While yield to maturity and required rate of return both are crucial concepts in bond investing, they serve different purposes and are used in different contexts. YTM represents the bond's internal rate of return, that is IRR, and the required rate of return, that is RRR, is the minimum annual percentage return an investor expects to earn from an investment given its risk. It reflects investors' risk tolerance and opportunity cost of capital. This is a very crucial line, that RRR, it represents the risk tolerance as well as the opportunity cost of capital for the investor. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. YTM versus required rate of return. If YTM is greater than RRR, the bond yields a return higher than expected by investor and the bond will be underpriced, that is worth buying. Why it is worth buying? Because it is offering you an yield which is greater than the rate of return that you require. So it is implied that in this scenario the bond will be underpriced and you would be tempted to buy such bond. If YTM is lower than RRR, the bond yields a return lower than expected by investor and the bond will be overpriced, that is, it is a situation we find worth selling the bond. And finally, when YTM is equal to RRR, the bond yields a return exactly as expected by investor and the bond will be fairly priced. Alright friends, once you have completed writing these notes, let us move ahead and take up the next follow-up example, that is example number 6. Consider the following information about a bond. Face value $1,000, annual coupon rate 6%, maturity 5 years, required rate of return by the investor, that is RRR 8%, current market price of the bond $940. You are required to determine the intrinsic value of the bond based on RRR, also determine the YTM of the bond, compare intrinsic value with the current market price of the bond and conclude whether the bond is underpriced or overpriced. What do you conclude when you compare RRR and YTM? And what do you conclude when you take YTM or RRR as discounting rates? So the later part of this question's requirement is more of conceptual understanding to answer that particular part of the question, and the initial part of the question set is all about computations. So let us first finish the computation part. Value of the bond is calculated as follows. So you know this, the discounting rate is 8%, coupon rate is 6%, par value is 1000. So the value of the bond will come to $920.15. And if you have to compute the YTM of the bond, it will be computed by taking a particular rate assumed as discounting rate, say I. So we don't know what is the discounting rate, but we know the pattern of the future cash flows and the present value. This is it. Now in this equation, if you determine the value of I, this I will be nothing but your YTM. So when you solve this equation, the YTM value that you are getting is 7.48%. I'll show you how to get this particular calculation on your calculator as well. Alright friends, once you have completed writing this entire thing, let us move ahead and observe the calculations on your financial calculator. Steps for YTM. So after turning on your calculator, without fail, what you need to do, press second and then FV for clear TVM. Then input 5 and then press N. Then input -940 and then press PV. Keep in mind one thing, this 940 is the current market price of the bond. If you input the intrinsic value of the bond, then the computed I by Y value will indicate the required rate of return. We don't want that because we already know it. We want to arrive at the YTM, and for computing YTM, you need to connect the future cash flows with the current market price of the bond. So it is -940 that you should input as present value. So input -940 and then press PV. Thereafter input 60 and then press PMT and input 1000 and then press FV. Now to compute your YTM, you just press CPT and then press I by Y. So press CPT and then press I by Y and you get the result as I by Y equals to 7.48%. Alright friends, once you have completed writing these steps, now moving ahead in your solution, whatever was demanded, we find one thing, that the market price of the bond is greater than its intrinsic value. So we will say that the bond is overpriced, indicating a potential selling opportunity. When you then compare the YTM with RRR, YTM is found to be lower than RRR. That means whatever be the required rate of return, bond is not capable of generating that return. That means the bond is not worth buying. If it is not worth buying, it is definitely worth selling because actually it is overpriced. So whenever we find this kind of situation, we conclude that the bond yields a return lower than expected by investor and bond is overpriced, that is worth selling the bond. So the conclusion is, when bonds cash flows are discounted using YTM as discounting rate, the resulting present value indicates the current market price of the bond. Alright friends, once you have completed writing this part, let us move on to the final round of conclusion, where we would say when the bond's cash flows are discounted using YTM as discounting rate, the resulting present value indicates current market price of the bond, and when the bond's cash flows are discounted using RRR as discounting rate, the resulting present value indicates the intrinsic value of the bond.